Hey everyone, welcome back to another video. So we are looking at a 15-minute time frame for a short entry. Both of these white horizontal lines represent previous day's high and low. These price points also give us our range with Fib's 50% retracement printing right around the 37.45 level. Down here we have previous week's low marked by this green horizontal line. There is also market resistance below the 37.70 level as indicated by the yellow dotted horizontal line. And here I think it's worth pointing out that this area was actually one of the main factors that pushed me towards my short bias. Now after this 80-point decline, we see the market retracing back to the upside after finding some support above previous day's low. After the initial move downwards, the price goes, as you can see from the chart, goes through a period of consolidation before starting to fall again. Following this short period of supply-side action, the upward trend resumes with this stair-stepping pattern that culminates with price getting close, and as I switch here to a 1-minute time frame, with price getting close to testing the 37.69 resistance area via this indecision bar at high volume. So the market then stabilizes and starts to move higher after this temporary movement in the opposite direction of the current trend. Obviously, this area now becomes our point of interest. The problem with this particular area, however, is that it is difficult to interpret since we don't have, I think, a clear confirmation of the market's directional bias. Yes, we do have this descending trend line as a common structural element preceding to a certain extent, obviously, preceding a downward move, but that's all we got. I think we need more confirmation. And here is where a 30-second time frame came really handy, as it not only acted as a better filter for the price movement, but it also provided with a confirmation and an entry point via an imbalance zone. From these observations, including the price is overbought condition, I concluded that the movement upwards was not sustainable. Based on that, I decided to enter the market with a short position.
Order filled.
Here we had a break in market structure, and as you can see from the chart, price kept rolling lower, rebalancing all this as it took out my first contract. I almost got stopped out on the second contract following this blow-off move designed by market makers to do what they do best, which is manipulate the market. Okay, with this trade done, let's move on to the second part of this video, during which I want to briefly discuss order blocks and give you a few pointers on how to find profitable order block trades. As we all know, order blocks, which are large trades placed by institutional traders to enter the market, are executed by block houses and outside of the regular order book. This means that these block trades, or order blocks, is the same concept, are not placed through the usual market channels, but rather they are negotiated privately between two parties. Because of this, order blocks tend to be large, usually placed for millions and billions of dollars, and can have a significant impact on the market. When an order block is formed, it creates a level of support and resistance, and that can be measured by the size of the supply and demand imbalance. The larger the imbalance, the more significant the order block will be. As a result, we can use order blocks to our advantage as traders by placing trades accordingly. That said, however, while order blocks seem easy to understand in theory, analyzing them on a chart often reveals they are not as clean as you would want them to appear. And what I mean by that is that sometimes you won't find that easily identifiable or clean down candle before a substantial up move, or an up candle before a major downward drop. And here we can talk a bit about refinement, but before we do that, keep in mind, guys, that order blocks should always be treated as points of interest. And that's because these are market zones where we see price potentially reversing. Obviously, the question here is, what if we have 2 points of interest? Which order block do you pick for an entry? Well, we don't know that, but this is where higher time frames and confirmations come in really handy. I think that the best and the simplest way to pick up the right order block for an entry is by looking for a break in market structure as the price approaches the order block's original level. This is usually a sign that the price will bounce back up or break down. Now, the reason why we want to have this kind of price action in relation to these types of order blocks is because they tend to leave a footprint in the charts and can be used as an indicator of future price movement. Keep in mind that Wall Street's top-notch firms who control the markets, they don't place their orders at once to prevent market instability. What they do instead is they space them out over time to create blocks. That's when the price retraces or pulls back into the original level of the order block, giving the smart money the window they need to place additional size orders. This market dynamic presents us with an entry point, and again here guys, the break in market structure is what defines whether an entry point is good or not. It's not obviously foolproof, but it usually works, particularly if we locate higher time frame order blocks, refine them down onto lower time frames for an entry. Now, this whole scenario will give us the assurance that that order block level is going to be respected rather nicely. So, the key to finding order block trades with a high probability of success is to first find order block zones which are located at the end of a strong trend. Once you find them, what you want to do next is draw a rectangle around the origin of the order block. This will help you understand market structure a lot better. And again here, don't look for massive moves to a certain direction. We are scalping, not swinging. So just simply try to trade between levels of supply and demand. After that, and as this diagram list shows, you allow the price to return, in this case to the bullish order block. Remember, a bearish order block indicates a large sell order by smart money, while bullish order blocks reveal a large buy order. So at this point, after establishing our point of interest, we pull the trigger only if price enters this blue shaded area. We then set our stop loss at the low of the order block. This is then followed by looking to the left of your chart and setting a price target right below the next bearish order block, liquidity grab or imbalance. We go through the same steps on a bearish order block trade. We first allow the price to return to the bearish order block and pull the trigger only after the price enters the blue shaded area. We set our stop loss just above our point of interest or at the high of the bearish order block. This is then followed by looking to the left of your chart and setting a price target right below the next bullish order block, liquidity grab or imbalance. Alright, so that should do it for this video. Thanks for watching, and if you guys liked the content, please make sure to like and subscribe to the channel. I would really appreciate it. With that said, thanks again and hope to see you in the next one.